Chris Jones here with the next video in our 24 rules for a successful business exit. My goal here is to provide you with an educational framework that can help you achieve your business exit goals. These are rules that my team and I have gathered from assisting thousands of business owners with successful exits for over 20 years. Now, if you like this video, please hit the like button and subscribe. In this video, we're going to cover rule number 8, understand the all-cash sale. Here's the bad news. While many business owners would love nothing more than to collect a large check at the closing table, hand the keys over to the new owner, and ride off into the sunset, the reality is that all-cash deals are rare. Here's the good news. A seller can still receive a majority of funds at closing, but in most deals, the seller agrees to accept at least some of the purchase price in deferred payments. This can be 10 to 20% in many cases. When it comes time to sell your business, there's a good chance that the buyer will use an SBA loan. SBA loans are a popular choice for buyers who may not have the full amount of cash on hand to buy the business outright. A typical SBA loan structure might look like the following. The buyer puts 10% down, the bank loans 80%, and you, the seller, carry a note for the remaining 10%. In this case, you'd walk away with 90% cash at closing. Or on a $2 million sale, you would receive $1.8 million cash at closing and $200,000 paid to you after closing. Now what about the remaining 10%, or $200,000 in this example? That 10% is what we call seller financing. The buyer signs a promissory note to pay principal plus interest over a specified period. As a seller, why would you want to do this? Well, first off, in our experience, buyers really like it. And my personal experience has been that you can negotiate a higher price when seller financing is involved. Buyers see deals with seller financing as less risky. And when buyers see less risk, along with decent growth opportunities, they tend to pay more. Second, there's a reason banks make loans. They make good money on their interest charges. When you seller finance a deal, you are now the bank. And check out these earnings. On every $100,000 you finance, you can make $45,000 at an 8% rate. That's a 45% return on your money. Seller financing also allows for creative deal making. Not all businesses and not all buyers will qualify for SBA loans. Any significant changes in revenue or earnings can make SBA loans much harder to secure, even if the business is still very profitable. For a buyer you really like, with the proper security, seller financing a significant portion of the price may be attractive. Now, you need to really decide how much cash you need at closing. If you have a lot of debt to pay off, this may not be a good option for you. But if you have low or no debt, and you like the interest earnings, and you'd like to defer some of the income for tax purposes on top of all that, seller financing may be a good option. If you enjoyed this video, please give us a like and subscribe to be notified on future videos. I'll see you on the next video.